Hello and welcome to BYJU'S Exam Prep IAS. Welcome to another session of Indian Economy Essentials. And in today's session, we'll have a discussion regarding the recent income tax survey that was conducted on BBC offices or at BBC offices. Now, before discussing what is the survey about, etc., let me give you certain basics here. Many of you will ask me, sir, what do you mean by income tax survey here? Why is it not called as income tax raid or income tax search? Let me start from there and then we'll slowly build to what is being alleged about BBC practices or activities. Now let me start. There is an act called as Income Tax Act of 1961, IT Act of 1961. Again, don't be confused between IT Act of 1961 related to income taxes and the other one is the Information Technology Act. I'm not talking about the latter, I'm talking about the former. That is Income Tax Act of 1961. Under Income Tax Act of 1961, you'll have to be focused on three very important provisions. First one, Section 92, we'll come to this in some time. Section 132 and Section 133. Section 92 talks about arm's length pricing. Again, do not worry about this. Just give me some time. We'll come to this. Arm's length pricing. And Section 132 talks about income tax searches. And Section 133 talks about income tax survey. Now, coming to the first point here. What is the basic difference between income tax search, income tax survey? Now, whenever you understand this, whenever a tax official believes that or there is a concern that a company or a taxpayer is evading taxes. What is the basic idea of evading taxes? Through illegal methods, a taxpayer will either underpay or not pay any taxes. And the term illegal is very, very important. Because apart from evasion or evading, there is another term called as avoiding. The basic difference is simple. Under avoidance, tax avoidance, a taxpayer finds a loophole in the taxation system and leverages that loophole, thereby reducing the taxes that they are paying to the government, which is avoiding. It is not illegal. Whereas, in case of evasion, by underreporting or not reporting the income, whenever you do not pay taxes or reduce your tax liability, that is called as tax evasion. So, coming back to the point here, whenever the tax officials believe that there is a possibility of a tax evasion, they will use Section 132 or 133 of IT Act of 1961 to find out or to get more information. But the difference is very simple here. Imagine this is the place of business, that is, let's say, office of a company. Now, the income tax officials will come to the office, ask for certain additional data, will search for certain data in all the files in the office, then go away during the business hours or office hours. They are not taking any files with them. They will come, they will search, they will seek additional data and they will simply go away. This is called as income tax survey, IT survey. Whereas in the second case, the income tax officials will come to the office, will also come to the residences of the taxpayers, will search, will ask for additional data, will take away the files, will take away the money, etc. And when I say take away, confiscate, seize the files and seize the money. This is basically referred to as a IT search or IT raid. Now, I'm pretty sure you are very clear with the difference between the IT search and IT survey. I said that whenever there is a possibility of tax evasion, the income tax officials can use this. Now, coming to the point, why in the recent times the IT officials went to the BBC offices and conducted a survey? I'm pretty sure all of you know that there is a reason to believe that they are basically evading taxes. Now, what is the allegation here? Again, I'm talking about allegations. Come to the section 92 of IT Act now. I said there is a concept called as arm's length pricing. Now what is the idea of arm's length pricing? Let's start. Imagine here is a company. The company, I'll call this as C1. They want to purchase a certain goods or services from company 2. I'll call this as C2. A simple question to you. Whenever C1 wants to purchase a good or service from C2, don't you think they will negotiate with each other? They'll try to come to certain agreement over the pricing, services, etc., etc. Because these are not related companies or unrelated companies, both of them want to protect their own interest. So what they have done? They have tried to protect their interest by negotiations. Now come to the next point here. Imagine there is company 1 and let's say company 2. Company 1 wants to purchase goods or services from company 2, but the owner of both of the companies is one and the same. Is it okay? The owner of both of the companies is one and the same. Now these are not unrelated companies. These are in fact called as related companies. And you think this kind of a practice, which is referred to as arm's length practice, will be followed here? Understand this. Do you think arm's length practices will be implemented whenever both the companies are owned by the same entity or are owned by the same person? Generally, they will not follow the arm's length methodology. And what is the problem with not following arm's length methodology? I'll introduce one more term here. Whenever related parties will conduct a transaction like this is called as a transfer pricing practice. Simple, this is referred to as transfer pricing practice. What is the idea for transfer pricing practice? Whenever the companies will conduct transactions, what is the price that they will quote for the goods and services that they are purchasing or selling? That is called as a transfer pricing practice. Now the problem is very simple. Imagine the company 1 is located in one country and the company 2 is located in another country. I'll call the countries as X and Y. Now look at this very carefully. Imagine company 1 purchases a good by paying 100 rupees and they want to sell it in the second country, that is country Y, at 1000 rupees. A simple question to you people. If they end up purchasing at 100 and selling it at 1000, they will record a profit of 900 rupees. Simple numbers. They'll record a profit of 900. And let's say country X has a corporate tax rate of 30% and country Y has a corporate tax rate of, let's say, 10%. Now, before going forward, let me ask you a very simple question. If this is a fact, that is X is charging 30% and Y is charging 10%, you tell me, as a taxpayer, you want to pay taxes in country X or country Y? I'm pretty sure most of you will choose country Y itself. So, argument is simple here. Why? Because the tax rate is very, very low. Now, what this company 1 will do is, they will set up another company 2 or another company 2 in country Y, and now will sell the product which they could have directly sold in the second country at, let's say, at 800 or let's say at 200 rupees. Not 800, let's say at 200 rupees. So rather than directly selling in Y, they will set up one more company C2 in country Y and sell the product at 200 rupees to C2, thereby registering a profit of how much? 100 rupees in country X. Now this company 2 will purchase the product at 200, will sell the product in country Y at 1000 rupees, thereby generating a profit of 800 rupees in country Y, on which they will end up paying 10% tax to the government. Now don't you think as a result of this particular practice, the amount of taxes collected by government X will be lower and government Y would be higher? Again, when I say higher in terms of, let's say, money. But the most important point that you need to observe is the company 1 and company 2, because the structure is done in such a way that the amount of taxes the company 1 and company 2 will end up paying will be very, very low, thereby reducing the taxes that the government is actually collecting. So there is an allegation. Again, this is just an allegation. And I'm not entering into the political aspect of the discussion because that is not relevant under GS paper 3 for UPSC Civil Services examination. Now you be focused on the terminologies that are being thrown around in the context of the income tax survey that has been conducted at BBC offices. So there is an allegation that the offices are using the transfer pricing methodology, violating the provisions of arm's length pricing, thereby reducing the amount of taxes they are paying to the government. So these are certain very, very important aspects, or let's say the concepts related to the recent discussion surrounding BBC in India. If you like this initiative, please hit the like button, provide your valuable comments in the section below, and if you are yet to subscribe to BYJU'S Exam Prep IAS, kindly do it now. Thank you. Have a great day.